Welcome, investors and traders. This video is about top 10 best technical indicators to use with RSI, Relative Strength Index. This video will give you multiple rule-based strategies to combine with this popular indicator. This video will not delve overall into the basic definitions of RSI Relative Strength Index, but will build on 10 indicators to start multiple strategy plan that will take away the uncertainty of investing or trading. In my own trading system, I have over 100 indicators to build a weight of evidence to time the overall market sectors and individual securities. These are some of the indicators to start you on your way to build a profitable trading system. You know the catchphrase: study it, analyze it, adapt it. The Relative Strength Index, RSI, is a technical momentum indicator that compares recent price gains against recent price losses. It is primarily employed by traders and analysts to indicate possible overbought or oversold conditions in a market. However, overbought and oversold assets do not necessarily turn around right away. That means it is beneficial to get confirmation from another trade signal before acting on RSI. How does the RSI work? RSI readings range from 0 to 100, with readings above 70 generally interpreted as indicating overbought conditions and reading below 30 indicating oversold conditions. Since the RSI measures the magnitude of recent price movements, it's prone to generating false signals following sudden, sizable price changes. Generally, when asset prices rises, the RSI will rise as well because average gains will outstrip average losses. When the asset price falls, losses typically outstrip gains, causing the indicator to fall. Indicator 1. Multiple RSI time frames. A time frame refers to the amount of time that a trend lasts for in a market, which can be identified and used by traders. Primary or intermediate term frames are actionable right now and are of interest to day traders and high frequency traders. Other time frames, however, should also be on your radar that can confirm or refute a pattern or indicate simultaneously or contradictory trends that are taking place. These trends can range from minutes or hours to days or weeks or even longer. By taking the time to analyze multiple time frames, traders can greatly increase their odds for successful trading. Reviewing longer term charts can help traders to confirm their hypothesis, but more importantly can also warn traders of when separate time frames are in disaccord. By using narrower time frame, traders can also greatly improve on their entries and exits. Ultimately, the combination of multiple time frames allows traders to better understand the trend of what they are trading and instill confidence in their decisions. The usual default setting is 14, but you can adjust the setting based on your trading or investment system. If you lower or decrease, the length of the RSI becomes more sensitive and you see more overbought and oversold. And if you raise or increase, the length of RSI becomes less sensitive and you see less overbought and oversold. Swing traders or medium traders are usually use 14, where short traders usually use 5 length. Choosing the right number depends on your trading style and system. Try testing with different settings lengths. Everything above the 70 line is considered overbought regions. With the lower length, you might want to raise the number higher to 80 or 90 on your line. Anything below 30 is considered oversold region. With lower length number, you might want to lower your number to 20 or 10 on your line. So in perspective, when the RSI indicator touches the 30 line, it is cheap, and the asset is considered expensive when the 70 line with a 14th length. Indicator 2. Moving Average Convergence Divergence, MACD. One technical indicator that can be used in conjunction with the RSI and helps confirm the validity of RSI indicators is another widely used momentum indicator, the Moving Average Convergence Divergence, MACD. This indicator calculates momentum differently from the RSI by comparing the relative position of a short and long-term moving average. Traders primarily monitor the MACD for signs of momentum diverging from price. While the price may continue to move up with the RSI maintaining overbought readings for quite some time, the MACD shows divergence by beginning to turn down as price continues to advance. That provides an additional indication confirming that a market may be reaching a level where it is overextended and therefore likely to retrace soon. The MACD and the RSI are both contrarians by design. They go against popular opinion by signaling to buy when there is a lot of selling and signaling to sell when there is a significant buying. When both indicate buying, then the security is more likely to generally oversold. Similarly, the security is probably overbought and headed downward when both RSI and MACD generate sell signals. Indicator 3, moving average crossovers. Moving average crossovers can be used to confirm RSI indicators that a market is overbought or oversold. RSI is often used to obtain an early sign of possible trend changes. Therefore, adding exponential moving average EMAs that respond more quickly to recent changes can help. Relative short-term moving average crossovers such as the 5 EMA crossing over the 10 EMA are best suited complements RSI. The 5 EMA crossing from above to below the 10 EMA confirms the RSI indication of overbought conditions and possibly trend reversals. Conversely, an upside crossover provides an additional indication that the market might be oversold. Indicator 4, candlesticks. Candlestick charts originated in Japan over 100 years before the West developed the bar and point and figure charts. In the 1700s, a Japanese man named Homama discovered that while there was a link between price and the supply and demand or rice, the markets were strongly influenced by the emotion of traders. Candlesticks show the emotion by visualizing representing the size price movements with different colors. Traders use the candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of the price. Candlestick charts are used by traders to determine possible price movement based on past patterns. Candlesticks are useful when they're trading as they show 4 price points, open, close, high, and low, throughout the period of time the trader specifies. Many algorithms are based on the same price information shown in the candle charts. Trading is often dictated by emotion, which can be used in reading candlestick charts. As a Japanese rice trader discovered centuries ago, investors' emotions surrounding the trading of an asset have a major impact on the asset's movements. Candlesticks help traders to gauge the emotion surrounding a stock or other assets, helping them make better predictions about where the stock might be headed. Indicator 5, super trend. As the name suggests, super trend is a trend indicator that indicates the direction of the price movement in a market is trending. A super trend indicator is plotted either above or below closing price. This indicator changes color based on the change in the direction of a trend. If the super trend indicator moves below the closing price, then the indicator turns green and gives a buy signal. Conversely, if a super trend closes above the indicator, shows a sell signal in red. Indicator 6, parabolic SAR. Parabolic SAR is another famous trend indicator that highlights the direction in which a security is moving. The indicator looks at a series of dots placed either above or below the price bars on a chart. A dot below the price indicates a bullish signal, and a dot above the price shows that the bears are in control and the momentum may remain downward. When the dots reverse, it indicates that a potential change in price direction will take place. Other than the above trend indicators, one can also use relative strength indicators and MACD as trend indicator. Indicator 7, Bollinger Bands. Bollinger Bands consist of 3 bands, the upper, lower, and middle bands. The middle band is the 20 days or bars moving average. The upper band is 2 standard deviations and the lower band is -2 standard deviations of the middle band. When the volatility in the market increases, these bands expand, and when the volatility decreases, these bands contract. Traders can trade with the Bollinger Bands when the prices break out from either side of the upper or lower bands after the low volatility or consolidation phase. Indicator 8, Donchan Channel. Donchan channels is a popular volatility indicator determining volatility in the market prices. This indicator is created by 3 lines, generally by moving average calculations. It consists of 3 bands, upper and lower bands around a medium band. The upper band shows the highest security price, where the lower band shows the lowest security price over a specific period, usually 4 weeks. The area between the upper and lower bands is the Don chain channel. Traders can enter a buy trade when the prices break from the above band, and they can enter a short position when the prices break from the lower band. Indicator 9, periodic highs and lows. The high and low levels in a specific period are periodic highs and lows. Users can be seen the number of stocks trading around their periodic high or low various periods. When securities trade at a price within 20% of its high-low range, it's eligible to be included in the period high-low analysis. Indicator 10, Commodity Channel Index. The CCI compares the current price to an average price over a period of time. The indicator fluctuates above or below zero, moving into a positive or negative territory. While most values, approximately 75%, fall between minus 100 and plus 100, about 25% of the values fall outside this range, indicating a lot of weakness or strength in price movement. The Commodity Channel Index is an extremely useful tool for traders to determine cyclical buying and selling points. Traders can utilize this tool most effectively by calculating an exact time interval and using it in conjunction with the RSI. Bottom line, when analyzing security, traders frequently employ a plethora of technical indicators. With thousands of different options, traders must select the best indicators and become familiar with how they operate. To generate trade ideas, traders may combine technical indicators with more subjective forms of technical analysis, such as chart patterns. Given their quantitative nature, technical indicators can also be incorporated into an automated trading system. So using the RSI in different time frames combined with other indicators will definitely give you a powerful tool. Remember, combining RSI on your trading journey, study it, analyze it, adapt it. Peace.